Hello, it's Steve Kalem with US Bank, and I hope you're having a great day. I wanted to reach out and make you aware of a strategy that I believe is really, really key for the market that we are now in, the market of continuing appreciation on homes, increasing interest rates, affordability being a major question, and let's face it, a reduction in the amount of offers that are being made on the properties and a reduction in the amount of bid over ask offers that are being made on the properties. So this strategy addresses the affordability question. It creates a situation where the buyer is turning back the clock to where their rate is low. They're buying a house that's on sale, even though it's a higher purchase price, the monthly payment creates the actual cost of the home to be on sale. And the seller nets out exactly what he was hoping to net out, expecting to net out is what I should say. So let me share my screen and walk you through an example because that's the easiest way. Okay, so I call it either the pre-market seller buy down discussion or the seller buy down listing strategy. So by this, I mean that I think it will work best in a pre-market situation when someone comes out and sees the home. They have motivation to make the offer before the house goes to open house and on the market. And the seller knows where they want to be and they want to get done with the deal and move on to the next. Or in a listing presentation, when you're talking to the seller and you're presenting to them how the market's changed and how to approach the situation. And they're kind of stuck in their mindset as to the price of the home. This is a way to increase the population of people who can afford this home. And let me just show you, I think that's going to be the easiest way. Let's walk through it. I've got 3 vertical columns. And the first column is, let's say, the listing presentation or the what the seller wants to net out in the pre-market situation, $1,250,000. The standard transaction that we're using is an 80% loan with a 30-year fixed with a payment, including taxes and insurance of that amount right there. This is a DC property. And the cash needed to close is just under $285 in DC, okay? Now, if we go up to the top here, you see that the income needed to qualify for this is about $170,000 with minimal credit obligations and good credit score. Okay, so you need 170,000 and that's your payment and your cash to close. What if the conversation was had and the seller would consider doing creative finance? By creative finance, we mean paying some closing cost, specifically paying points to reduce the interest rate. And in the case that I'm showing here, the illustration I'm showing here, I'm having the seller pay 3 points to reduce the interest rate. And so 3 points on column 1, $1 million loan is $30,000. So in column 2, we've increased the loan amount, the purchase price from $1,250,000 to $1,280,000. That's the $30,000 the seller is going to pay towards points, or if they want, the buyer wants towards closing costs. Okay, so that allows the seller to net out exactly what he was netting out before, subject to transfer recordation tax and maybe commission, which can be ironed out and covered later on so that it's the same to the seller. Now we're looking at an 80% loan, and look what that does to the interest rate. It drops it by almost 1 full percent from 4.75 to 3.875. And look what that does to the monthly payment. It drops it down $652 a month every month, which reduces the amount of money that's needed to qualify for this loan. In fact, if we go back up to the blue, you see that now someone with $116,000 annual income can qualify for this house for $1,280,000. So 116, they've got to have no credit, pretty much no obligation. But let's say 116 to 120,000 as opposed to 170,000. It's a whole different ballpark of people now that are looking, who are going to be more flexible in their view of it, because now they're getting a house that is way more than what they felt that they could afford, and they'll be more open to being flexible and in the neighborhood and with the schools and everything else. Now let's follow it down to finish the analysis. With the higher purchase price comes the higher down payment with 20% down. So the down payment is 290 and change. Let's call it 291. So it's about $6,000 more than the list price was scheduled for, which in essence is that's the 20% down on the $30,000, the difference in the increase in the purchase price. I'm going to come back to this because it's actually cheaper for this person to buy the home than in column one. But coming back on this and continuing to look at, let's turn this dynamic upside down. If the payment is now $43.36 monthly, all in, if we take that and look at what that payment would mean in today's mortgage rate environment when the 30-year fixed is 4.75, what kind of mortgage would that generate? We come up here and that's an $880,000 loan. And we're talking about an 80% scenario, people putting 20% down. That means that they would be buying a 1,000,001 home. So 1,000,001, you're getting a house for 1,280,000. You're getting an incredible deal for $180,000 less in monthly payment. So again, a tremendous value to the buyer. And we look at this and we go down 880 at 4 3/4 is an actual mortgage payment of more, 43.83. It's about $50 more than the second column, the basically the buy down column. Okay. Now the cash to close is lower because of the lower purchase price. But I'd argue that we could also do 85% loan or 90% loan. It's not an issue. Okay. They're getting a tremendous deal. Now, lastly, let's go back to column 2. This is cash to close 290 as opposed to 284. This is paying points. The definition of points is prepaid interest. Interest is tax deductible to $750,000. So this lucky buyer in number 2 would get a tax deduction for 3 points on $750,000. I don't remember what that is. That's 15. That's 22.5. So in their tax bracket, they would get typically in that tax bracket about $9,000. Let's call it from $7,000 to $9,000 back on their taxes. Let's go back and look at this. If they got $7,000 to $9,000. That would bring them into at 282, 283, and all the way down to 280 to 283 here compared to 284 here. You're paying less. You're getting a much better rate. You're getting a much lower payment. You're getting more people to qualify for the home. All right, I'll stop the share right there. I'm happy, very happy to do this on a one-off basis, to talk to the sellers for you, to present this prior to your listing appointment so that you can present it to them, to even do a video. I can do a chart for you so you can explain it, or I'll do a video. Or in a case where you've got an interested party in a pre-market situation, happy to put this together and do the calculations so it makes sense for everyone, and do a video so you can send this to the people, or I'm happy to walk people through. Okay, hopefully this wasn't too long. It's a lot of information, but I hope it is a benefit to you. And let me know if you have any questions. I look forward to speaking with you in the future. Take care. Bye-bye.